Understand your financial position. Before buying an investment property, step 2 of the 10 essential steps for real estate investors. Before you buy an investment property, before you submit an offer, before you talk about cash flow, before you calculate appreciation, and before you imagine building long-term wealth through real estate, you need to stop and understand one very important thing: your financial position. Because real estate investing does not begin with the property, it begins with you, your credit, your income, your reserves, your debt, your borrowing power, and how much risk you can realistically carry. A lot of beginner investors make the mistake of jumping straight into the exciting part. They start looking at properties, they start watching videos about rental income, they start calculating cash flow, they start thinking about tenants paying the mortgage, they start imagining appreciation, equity, refinancing, and long-term wealth, but they skip the foundation. And, in real estate, when the foundation is weak, everything above it becomes dangerous. A property may look like a good deal on paper, but if you are not financially prepared to own it, maintain it, and survive unexpected problems, that same property can become a burden. So before asking, "Is this a good investment property?" you need to ask a better question. Am I financially prepared to own this investment property? That is where serious investing begins. Let's break this down from the ground up. 1. What does your financial position actually mean? Your financial position is the complete picture of where you stand financially right now, not where you hope to be, not where you think you will be next year, not where you would be if everything goes perfectly. Where you are today. Your financial position includes your credit profile, your income, your savings, your emergency reserves, your debt, your ability to borrow money, and your ability to handle financial pressure if the property does not perform exactly as expected. That last part is important, because real estate does not always go according to plan. Tenants move out, repairs happen, insurance increases, taxes increase, appraisals can come in low, contractors can go over budget, interest rates can change, markets can slow down, local rules can change, and sometimes the property simply costs more to operate than expected. That does not mean real estate is bad. It means real estate is real, and real investors prepare for reality. A beginner may look at a property and say, "The mortgage is $2,500 and the rent is $3,000, so I make $500 a month." But that is not a full analysis. What about repairs? What about vacancy? What about maintenance? What about insurance? What about property taxes? What about water, sewer, garbage, landscaping, snow removal, pest control, permits, inspections, legal fees, accounting, property management, and reserves? Your financial position determines whether you can handle all of that. So do not ask only, "Can I buy this property?" Ask, "Can I safely own this property?" Those are two very different questions. 2. Credit, your financial reputation. The first part of your financial position is credit. Your credit is your financial reputation. It tells lenders how you have handled borrowed money in the past. Have you paid your bills on time? How much debt are you carrying? How long have you had credit? Do you have collections? Do you have late payments? Do you have charged off accounts? Do you have judgments, bankruptcies, foreclosures, or other serious negative items? Many people focus only on the credit score, but your credit score is only part of the picture. Your credit report matters too. A lender may look at the score, but they may also look at what is behind the score. Your payment history matters. Your balances matter. Your credit utilization matters. Your recent inquiries matter. Your account history matters. Your derogatory accounts matter. Your overall pattern of behavior matters. For real estate investors, credit matters because it can affect your approval, your interest rate, your loan options, your down payment requirement, your closing costs, and your monthly payment. And your monthly payment affects your cash flow. So credit is not just a personal finance detail. Credit can directly affect whether an investment deal works or does not work. Imagine two investors buying the same property, same purchase price, same rent, same taxes, same insurance, same property, but one investor has strong credit and qualifies for a better interest rate. The other investor has weaker credit and receives a higher interest rate. The property is the same, but the financing is different. The investor with the higher rate may have a higher monthly payment, lower cash flow, and less room for error. That means the same property may work for one investor and not work for another. That is why credit affects buying power. 1. Credit scores and credit scoring systems. A credit score is a numerical estimate of your likelihood to repay borrowed money. Lenders use it as a risk measurement tool to decide whether to approve you and what terms to offer. Scores often range from 300 to 850, and a higher score can mean better loan terms. But here's a key point. You don't have just one credit score. The score on a free app may not be the same one a mortgage lender uses. Common systems like FICO and VantageScore calculate scores differently, and even within FICO, there are specific versions for mortgages, auto loans, and credit cards. So, treat your credit as a business asset. Speak with a lender to understand which score applies to your financing, because your cost of capital can make or break a deal. 1. What affects your credit score? Let's break down the major factors that affect credit scores. First, payment history. Paying accounts on time is crucial. Late payments hurt your score and make you look risky to lenders. Second, amounts owed. High credit card balances can reduce your score. Keeping your credit utilization low looks stronger. Third, length of credit history. A longer history of responsible credit helps, so think strategically before closing old accounts. Fourth is credit mix. The different types of credit you've managed. And fifth, new credit. Applying for too much credit in a short time can lower your score. Protect your credit before and during the financing process. 5. Income. What you earn and what you can prove. The next part of your financial position is income. Income matters because lenders want to know whether you have the ability to repay the loan. But income is not always as simple as saying, "I make enough money." In lending, the question is, what income can be verified and used to qualify? That matters. A salaried employee may be easier to document. An hourly employee may need pay stubs and W-2 forms. A commission-based borrower may need a history of commission income. A self-employed borrower may need tax returns, business records, profit and loss statements, or bank statements. Rental income may need leases, tax returns, or market rent documentation. So as an investor, you need to understand two types of income. First, your real-life income. That is what you actually earn. Second, your qualifying income. That is what a lender can actually use. Those two numbers are not always the same. Someone may make good money in real life, but if that income is not documented properly, or if tax deductions reduce the income shown on paper, the lender may not be able to count all of it. This is especially important for self-employed buyers and investors. You also need to ask yourself, is my income stable? Is it consistent? Does it fluctuate? Is it likely to continue? How much of it can I prove? Could I still carry the property if my income temporarily dropped? Because if your income drops at the same time your property has a vacancy or major repair, you can be placed under serious pressure. And pressure is where bad decisions happen. You may accept a bad tenant. You may delay necessary repairs. You may use high-interest debt. You may sell at the wrong time. You may panic. That is why understanding your income is not just about getting approved. It is about knowing whether you can safely carry the investment. 6. Reserves. The money that protects you after closing. Now let's talk about reserves. Reserves are the money you keep available after the purchase. This is not your down payment. This is not your closing cost money. This is not the money used for inspections or appraisals. Reserves are the money left over after closing to protect you, and every serious investor needs reserves. Why? Because properties need money. Even good properties need money. A tenant can move out. A unit can sit vacant. A roof can leak. A water heater can break. A furnace can stop working. An air conditioning system can fail. A city inspection can require repairs. Insurance can increase. Taxes can increase. A tenant can stop paying. And when those things happen, the property does not care whether you are ready. The bills come anyway. Without reserves, a normal property problem can become a financial crisis. With reserves, that same problem becomes manageable. There are different types of reserves. Emergency reserves are for unexpected issues. Vacancy reserves protect you if rent stops or the unit is empty. Repair and maintenance reserves cover normal wear and tear. Capital improvement reserves are for larger items like roofs, HVAC systems, plumbing, electrical, windows, and major building repairs. A serious investor does not spend every dollar just to buy the property, because if you close with no money left, you may own the asset, but you have no protection. Buying the property is not the finish line. Buying the property is the starting line. Reserves help you stay in the game. 7. Debt, the weight you already carry. Now let's talk about debt. Debt is not automatically bad. In real estate, debt can be a tool. A mortgage allows you to control a larger asset without paying the full price in cash. That is leverage. Used wisely, leverage can help build wealth. Used carelessly, leverage can destroy wealth. Before buying an investment property, you need to understand the debt you already carry. Credit cards, car loans, student loans, personal loans, business loans, existing mortgages, tax debt, payment plans, child support. Any monthly obligation matters. Why? Because debt affects your debt-to-income ratio. It affects your borrowing power. It affects your monthly cash flow. And it affects how much pressure you can handle. If you already have heavy personal debt, adding investment property debt can become dangerous. Even if the property has rental income, your personal finances may still need to support the property if something goes wrong. If rent stops, repairs happen, or the property underperforms, you may have to carry the weight. That is why high-interest debt is especially important. Credit cards and personal loans can weaken your financial position. Sometimes the smartest move is to reduce expensive debt before buying real estate, not because real estate is not valuable, but because you want to invest from a position of strength. A strong investor knows their debt. They know their monthly payments. They know their interest rates. They know what debt is helping them and what debt is hurting them. 8. Borrowing power. What you can qualify for versus what you should carry. Now let's talk about borrowing power. Borrowing power is how much financing you may be able to obtain based on your credit, income, debt, assets, down payment, reserves, loan type, and lender guidelines. But here's the warning. What you can qualify for is not always what you should buy. A lender may approve you for a certain amount, but that does not mean you should automatically buy at that maximum number. The lender is looking at guidelines. You must look at reality. You must ask, can I carry this payment comfortably? Will I still have reserves? Can I handle vacancy? Can I handle repairs? Can I handle higher insurance? Can I handle higher taxes? Can I survive if the rent is lower than expected? Can I carry the property if my income changes? That is responsible borrowing power. A beginner asks, how much can I get approved for? A serious investor asks, how much can I safely carry? That is a very different mindset, because financing should support your strategy. It should not trap you. If the payment is too high, the cash flow may disappear. If the loan terms are wrong, the investment may not work. If the debt is too heavy, you may lose flexibility. So do not confuse approval with affordability, and do not confuse borrowing power with safety. 9. Risk. How much can you realistically carry? Now let's talk about risk. Every real estate investment has risk, every single one. There is market risk. The value may not go up the way you expected. There is tenant risk. A tenant may pay late, stop paying, damage the property, or leave. There is repair risk. Something may break sooner than expected. There is financing risk. Rates can change, refinancing may not work, or loan terms may not match your plan. There is insurance risk. Insurance can become more expensive. There is tax risk. Property taxes can increase. There is legal and regulatory risk. Local rules can change, especially with rentals, short-term rentals, permits, inspections, and landlord-tenant laws. There is personal risk. Your job, income, health, family situation, or business can change. So the question is not, is there risk? The question is, how much risk can I realistically carry? If the unit is vacant for 3 months, can you survive? If a $10,000 repair appears, can you handle it? If insurance increases, does the deal still work? If taxes rise, does the cash flow disappear? If a tenant stops paying, can you carry the mortgage? If the market slows down, can you hold the property? These are not negative questions. These are investor questions, because investing is not about pretending everything will go perfectly. Investing is about preparing for what happens if it does not. Do not copy another investor's strategy if you do not have that investor's reserves, income, credit, experience, team, or risk tolerance. Your job is not to impress people. Your job is to survive the investment and grow responsibly. 10. Why this comes before property analysis. Your financial position must come before property analysis because the same property can be good for one investor and dangerous for another. Same property, different credit, different income, different reserves, different debt, different borrowing power, different risk tolerance, different outcome. That is why there is no universal good deal. There is only a deal that works for a specific investor under specific conditions. So stop asking only, is this a good property? Start asking, is this a good property for me, based on where I am financially today? That question can protect you, because the wrong property can drain you. The wrong financing can trap you. Too much debt can pressure you. Too little reserves can expose you. And too much risk can overwhelm you. Smart investing starts with self-awareness. Know your numbers first, then analyze the property. Closing message. So before you ask, is this a good investment property? Ask yourself, am I financially prepared to own this investment property? Because the deal is not only about the property, the deal is also about your ability to carry it. Your credit matters, your income matters, your reserves matter, your debt matters, your borrowing power matters, and your risk tolerance matters. A property may look good on paper, but if it stretches you too thin, drains your reserves, increases your stress, and leaves you with no margin for error, it may not be the right deal for you. Smart investing is not just about buying assets. Smart investing is about protecting yourself while you build assets. So remember this: before you invest in a property, understand the financial foundation you are standing on, because a weak foundation does not only hurt buildings, it hurts investors too. I highly recommend you take a real estate licensing course in your state. I cannot emphasize this enough. It is to your advantage personally and professionally. Even if you never become a practicing real estate agent, the knowledge you gain can help you understand contracts, agency, disclosures, ethics, financing, property law, fair housing, negotiations, timelines, and the overall transaction process. That knowledge can make you a more educated, more confident, and more prepared investor. This is step 2 of becoming a smarter real estate investor. Understand your financial position before you buy, because when you understand your credit, your income, your reserves, your debt, your borrowing power, and the risk you can realistically carry, you stop guessing, you start investing with discipline, and discipline is what separates a hopeful buyer from a serious investor. Keep to 15 minutes,